Hello and welcome to Market Outlook. This is Jeff Bish, President of Market Gauge, filling in for Keith this week. So let's take a quick look at how the economic data may have influenced the markets, and more importantly, what the markets are telling us they're likely to do for the coming week or weeks ahead. Now, last week we didn't have a video, but the week before that, in that video, I believe I talked about leadership and looking for leadership, and I'm going to address that again this week. But this week I think we've got a couple of interesting points that have developed that have to do with market breadth and also have to do with gold. So let's get started. On Tuesday this week, we had a interesting pattern, and the interesting pattern was that the markets ran up, in many cases made new highs, and I'll point that out in a minute, but then sold off pretty hard for a one-day move. More importantly, closed, in the case of the SPYs, you can see well below the prior day's low. Now, the interesting thing here, and this is one of the interesting things I want to point out about this week, is that while I don't always focus on what the cash market is doing, I do at least keep half an eye on it in case there's something different about it. And that happened this week. So SPY here represents the S&P 500. However, that's the ETF. However, the actual cash index for S&P 500 did something a little different on that Tuesday. So if you'll notice, the difference here is you've got the INX, when the cash index actually continued to climb higher, and on this reversal day made a significant new high. Whereas if I put side by side, let's do this, put the SPYs down here and blow it up, you can see that the action in the INX here is substantially different than the action in the SPYs. Now, I don't have a really good technical reason for that, but the important thing here is that the cash made a real new high. We're not talking about a couple cents, and then sold off, just like INX did, and created that key reversal pattern, a really legitimate key reversal pattern. Now, in this case, we can see that the SPYs and INX, for the most part, have traded in a very similar fashion since that point. Both of these, really, for the objective here to move higher is to take out this key reversal high, take out the ultimate high. That's what we want. That's what the bulls want to see. And from the standpoint of when should we expect to look to the bear side, for me, once we get below this this week's low in either index, and I'm going to say in pretty much all the indexes, then we can look for a bearish bias. Until then, I think you have to focus on the fact that the market's going higher. All right, so let's take a look. Same idea now in Qs. So over here to the right, you can see that the Qs actually did take out. The Qs did take out that day, the Tuesday high that then sold off. But also notice that the Qs didn't close below the prior day's low. They managed to close right in the middle of the range. This green line is the 10-day moving average. So for all intents and purposes, really all the Qs did was take out this nice, let me see if I can get a pen. I don't know what I did by asking for the pen. All the Qs did was take out this nice consolidation area, come back into it, and the key level in the Qs really is down here around the 92 level. So the 92 level is what I'd like to see taken out in order to look to the bear side. Until then, Qs seem to be the leader, and Qs have taken out that sell-off day. Here is where it gets a little more interesting. Just like I look at the cash in the SPYs, and that's the INX, here's the cash for NASDAQ, and NASDAQ as a whole. So this is much broader than just the Qs, which is the top 100. But we like to look at IWM as a broad measure of the markets. This is another broad measure of the markets, COMPX. And the interesting thing that has happened this week, if I blow this up a little bit, is let me enable me to do this, is that you can see the NASDAQ, the broad index, is breaking out to new highs on the year for the first time. Right, so this week is a really significant breakout here. And what this means is that if we were looking for a double top in a major market, that double top would is now set up to happen if the markets can break down below these support levels. Now, I'm not suggesting that that is going to happen, but I am saying very much so that you want to watch out for it to happen. I always like to know whether or not I want to be on the bull side or the bear side, and when I want to flip that bias. And I would flip that bias when we get back down below this line. Let me just get rid of my. So that level really is in here around the 4,335 level. It's essentially breaking this week's low. Would be the first heads up. Also note that while the Qs took out their Tuesday high, the NASDAQ Composite did not. All right. So from a broad measure, one thing happened that was really significant for the bulls. We've taken out and closed above the highs for the year. Something that hasn't happened until this week, so it's definitely noteworthy. This is very comparable to looking at IWM, right? And if we look at IWM is still substantially below its lows for March, right? So that, on one hand, is a very bullish statement. On the other hand, it's also a great kind of setup for waiting for the bearish reversal of that. So let's move to IWM since I've got it here. And again, IWMs didn't take out that Tuesday reversal, right? So IWMs have a really interesting, powerful key reversal up against the highs for the year. Hasn't broken out the highs for the year. If this were to continue lower, we're all going to look back at that and say that was the day, that was the signal. So I'm still saying that. Keep an eye on that day. And if the market continues to break higher, I'd follow it. But if it breaks lower, below this week's low, call it the 116 level, that's a big negative sign for the markets. So let's take a look at one last thing, and that's the TLTs. Right, so here's interest rates. We had GDP data this week that was surprisingly weak, and we had inflation data that, I don't know about surprisingly, but I think for some it was surprisingly strong. That sets up a potentially dangerous situation for the Fed. Weak growth and higher inflation. Nobody wants to see that, but let's not worry about it. Let's just focus on how the market reacts to it. The TLTs, on balance, moved higher. Rates moved lower. What does that mean? Well, it means that the TLTs for right now, are not really freaked out by where the inflation is. And that's what we would have to worry about longer term, looking out quarters ahead, maybe half a year ahead. If the bond market or the stock market starts to really fear inflation, that's problematic, right? But don't let the headlines scare you. Focus on what the markets do. Right now, TLTs are telling you they're not worried about it, or at least they weren't worried about it today. And that's where gold is going to get interesting later in this conversation. So TLTs moving higher. I'd say TLTs are pretty much in the middle of nowhere for the perspective of the next couple weeks. They should have good support down here. If they break through all this, they're through the 50, and then the trend could be pretty strongly down. Until then, I think you got to follow them and look for support around the 112.50 level. TLTs moving up can be good for stocks as long as it's slow and constructive, and it doesn't represent the market's looking for safety. And we want to keep an eye on that from a day-to-day basis, as we've told our trading room. But as long as TLTs move higher, I don't think the majority of participants were thinking that TLTs would continue to move higher with continued reduction in quantitative easing, but markets like to surprise. Markets have been doing that for months. So all the hype about once quantitative easing stops, rates are going to go through the roof. stocks will get crushed has been proven absolutely wrong. Just follow what the markets are doing. Right now, rates seem to agree with what the Fed is doing, and all is good. And I will continue to say that until TLTs get below the 110.80 level. All right, so now let's drill down into the breadth of the market, the internals. So the markets have moved higher or went somewhat sideways this week, but they're still strong, right? They're still up near the top end of recent ranges. The interesting thing here is that the McClellan, which measures advanced declines or breadth, really has gone nowhere. It's in the middle of nowhere, and until it gets above 150 or below minus 150, it is effectively nowhere as far as I'm concerned. I'd actually feel better if it was higher, pushing the 150. A little bit of concern is that markets have been kind of creeping higher, and this has stayed flat, suggesting that the advanced declines really aren't getting any stronger with a slightly stronger market. That said, in the middle of the nowhere right now, for this particular point in time, only tells me that I can't say the market's overbought or oversold on a market breadth standpoint. I don't give it much weight this week to try and figure out which way the market's going to go. In terms of sentiment, as measured by VIX, we did have an interesting pop, not surprising in the VIX, but it's from such a low level. And it's not surprising given the market action right there. But the interesting thing here is that as the market's gone sideways, it's continued to fall back lower. What does this suggest? Complacency, more complacency. As you know, if you watch the Outlook, this video every week, when the complacency gets down to the bottom of this band, we start to suggest that it's too complacent and the market could go sideways or even reverse. We've seen that since the last signal, but the signal's, for all intents and purposes, worked its way off. You can see in this particular signal, same thing. Markets went sideways, a little bit of down. So really, from a VIX point of view, there isn't much to say, nothing active for the coming week. Just keep an eye on if the VIX really drops. If the market moves higher, VIX really drops precipitously, drops down under, say, the 1030 level, and I'm talking about cash VIX, then we might have a situation where we've gone a little too far, too fast in the markets. But until then, can't really say a whole lot. One of the other ways I talked about looking at the market breadth, and I'm not going to go into the other advanced decline lines because they're just not showing anything different than I said about the McClellan, and I want to save time for gold. So one of the other things we talked about in the last video was the new high, new low ratio, and looking at that in terms of market leadership. And what we don't want to see as the markets move higher is this advanced decline ratio, which is, new high, new low ratio, which is the number of new highs divided by the total number of new highs, total number of new lows. If this percentage drops below this 70 level and continues to point down on a trend basis, it's negative for the market. So in other words, in here, when it rolled over and got under 70 and continued to move down, it's negative for the market. Again, in here, down 70, negative for the market. We look for the opposite to be true, bullish for the market, if you can come under the 30 and then come and turn back up. As you can see, worked pretty well in through here. So the fact that we're pushing this 70 is something to keep an eye on. The other thing that's a little bit concerning is that here's the total number of new highs, and that is significantly less as we push to new highs here than it was when we were pushing to new highs there. Right, so that is not what we want to see. We want to see a nice, and so if you don't have this ratio, what you want to be looking at is, in this case, we're looking at NASDAQ. We want to see the NASDAQ number of new highs be hitting over 150, really over 200. A big number is 250, 300 plus. All right, but we haven't seen that in quite some time. And if NASDAQ, which is supposed to be leading, is really going to continue to lead, we need to see 150, 200 new highs as the market pushes higher. If we don't, the red flags are going to start to go up. If we look at the same information on New York, we see that New York has been stronger, right? The ratio here is way over 90, and that's what you like to see. Until it comes back down under 70, it's pretty much bullish. You do need to or will want to be a little bit more cautionary if the trend starts to be steadily down and you've got NASDAQ already under that 70 level. Again, the reason I'd say that is because, well, this has been pushing higher this week. The number of new highs at 300, not bad, but not pushing really good new highs, which in New York would be 400, 500 when the market's really strong. All right, so if the markets push higher, and let's say they're not clearing that 300 new high level, you know that the leadership is getting weaker. Right? Again, focus on price action. So you still want to be focused on those price levels that I started the video with. But this will tell you if a market moving higher is actually not as strong as it used to be. It'll also tell you if markets are moving lower, if this leadership breakdown ratio, if this ratio really breaks down, then the leadership is really breaking down too. All right, so with that, let's take a look at another ratio that I pointed out the last time in the last video 2 weeks ago. And I pointed it out because, and let me first review what the ratio is. If we take a look at the defensive sector of staples versus a more bullish sector, which is the discretionary, consumer discretionary, the ratio between the stocks in these two groups often can give us a heads up as to whether or not the market's sentiment is really bullish or whether the market's defensive, even though it might be looking okay in terms of price action. So I just have circled the last couple of situations where this has been interesting. Down here is simply the ratio between the XLP and the XLY. If this ratio, which is the black line, gets up above the magenta line, which is its 20-period moving average, the overall markets tend to have trouble or can be in a negative trend. And you can see that while it's not always perfect, it's a good indication if you've got consistent action above the moving average. You can see that the broader measure, IWM, during that period didn't fare so well. SPYs managed to continue higher, the broader market didn't. When it happened again, popped over its head, you got more of a negative reaction in both of these situations. Now, when you look at ratios like this or any indicators, you really want to look for scenarios where the price action starts to confirm what your ratio is saying. So in this case, as the markets start to roll over in IWM and SPYs, you would know that this rollover is dangerous because the market has been more defensive. Right? If the markets continue to go higher, you won't argue with it. Now in this case, you can see the ratio really got into a strong trend, one that would have been bearish for equities, and in fact in IWMs has been quite bearish for equities, or was, I should say, during that same period. SPYs managed to hold up and go flat, but certainly they didn't make any headway to the upside. Then as the ratio got weak, stock overall indexes moved higher. So I pointed out in the last video that we'd watch out for this indicator that was getting close to that breaking point, and you really want to see it trade over there for several days. You want to see somewhat of a trend. You know, one day over the average is not one to set off alarm bells. So we were watching out to see whether or not this breaks higher and continues to move higher, which would have been even more significant given the overall trend having really seemed to have reversed after a long period of moving down. So it didn't happen, and in fact what looks like it may have happened is it tested the higher side with a little bit of the blip down, that's probably Tuesday, and then has reversed and started to move lower. So if this ratio continues to move lower, and this is what I'll look for in the coming week, if it continues to move lower and markets continue to push higher, it means that the market's pushing higher in an environment where the groups that are pushing higher are not the defensive groups, the discretionary stocks, and that is a bullish sign for stocks. All right, so There's also an interesting dynamic going on right now with gold. So let me just pull up the gold chart. And with the inflation data on Tuesday, makes gold a little bit more interesting, perhaps. I'm not really a big believer in the inflation-gold relationship anymore. I think it may be a little arcane at this point, but again, I'll follow what the markets say. The interesting thing here with gold is it really had a nice pop, and we're going to see it on a bigger chart. But if you look at GLD here, the question is this pop for real? Is this base for real? And if it is, it certainly has plenty of room to run, right? Throw in a little fear of inflation. Again, I'm not saying we should be fearful of it, but let's let the markets decide, and maybe gold really gets going. The other thing that makes gold really interesting here is that GDX has also moved up with it. I like to focus on gold when GDX is also in agreement with the trend. And it is very much so here. And you can see, you might even have the looks of a really interesting head and shoulders bottom, with this being the shoulder, this being the head, and this being the shoulder. And I really like when markets come back and test prior swing lows. So this break above the 200 and then pull back right to where you'd expect it to pull back to is technically looking very nice. Furthermore, if I put a trend line, we'll see the trend line in the next charts. So let's take a little deeper look at gold. First, here's closing GDX and closing gold. So here's the gold ETF, GLD, and GDX, which is the miners. Again, this is that pullback to the support level that I was saying I liked. Well, let's use this as the trend line now. So now if we draw the trend line, well, I know it's not a perfect trend line because we didn't make a new low here. This breakout would represent a really nice looking head and shoulders, and that would be the break and the move higher. So with GLD itself has been a little bit stronger relative to that pullback, but it still looks good. The fact is they both look good. So here's where I think gold really gets interesting, and here's a perspective I don't think you're going to find anywhere else, or at least without digging for it. So here is a ratio of GLD to TLT, so gold to interest rates. Now the best situation for gold would be that there's some fear of inflation, and if there was fear of inflation, TLTs would fall, rates would go higher. In that environment, there's always going to be a balance between when do TLTs become more attractive to gold if they're falling. But what does tend to happen, and I'll show you this in this chart, is if you take GLD and put it over TLT, you'll get the ratio that we see below. The blue line is the day-to-day ratio, the red line is the 20-period moving average. And so what I want to point out here is that when gold is outperforming bonds, the blue line is over the red line. And if gold is outperforming bonds and the gold price is moving up in a constructive way, just from basic technical analysis, that's been the best time to look for a good trend in gold. For example, let me just see if I can get my pen. Won't let me get the pen. I'm not sure why. So in here, you can see that the ratio turned bullish, and the gold action from breaking this trend started moving up in terms of bullish. The vertical lines here are drawn every time you made somewhat of a significant change up or down relative to the ratio versus the 20-period moving average. So just kind of, I'll start from back. Here, again, this is gold, just on a closing basis, and this is the ratio. So the ratio breaks down, and gold is kind of breaking down here. As the ratio gets kind of chopped here, the question is whether or not this is going to hold this price or whether or not it's going to drop. Well, you can see the ratio really breaks down as gold is flirting with those low levels. So it was not really a surprise here to see that gold get pummeled. Your ratio at that point was already very negative. So in short, gold's trend looked like it's heading down. The ratio is definitely heading down. That's the direction you want to follow, right? In here, as it consolidates, it can get a little choppy, but gold, again, starting to break down. The ratio breaks down with it. Gold has a nice move down. Is gold going to recover? Well, the ratio recovers, and the ratio continues to move higher as the gold price moves higher. So that's the kind of relationship we're looking at. Fast forward to right now. You can see the ratio has spent a fair amount of time on the negative side. Gold has struggled, which we know. It's pulling back after a nice move up, which was also accompanied by the ratio move up. Now gold gaps up, moves higher. That pushes the ratio as well higher. What does this mean? Okay. What it means to me is that if gold starts to move higher, the ratio is in a great position to support a further move higher. Given the base, head and shoulders, and GDX patterns that we've just seen, gold could be a really interesting play. Is gold ready to outperform the SPYs? Well, if you've watched this outlook for a while, you've seen me pull up this relationship as well. This is a weekly relationship to gold to the S&Ps. Now, is gold going to be a better place to be than the SPYs? Right now, the answer to that is no, not yet. This ratio would have to trade, in this case it's reverse, apologize for that. The red line is the week-to-week level, and the green line is the average. Gold tends to outperform the SPYs when this ratio is above the average. So I'm not saying sell your stocks and buy gold, but I am saying gold does look like a very interesting place here to follow any breakout of the consolidation in that metal. So hope that helps. Hope that's interesting. I think what all of this is pointing to is that the environment right now is definitely one for a stock picker. And there's going to be plenty of opportunities in terms of swing trading and day trading. Buy and hold, I'm not so sure now's the time. With that, hope this helps, and we'll see you in the next video.